We've had so many breaks in gold since, well, we went into a trading range. We all know it. 2020, summer 2020, gold hit 2,000 plus, okay? And for the next couple of years, it kept going over 2,000 and dropping, 2,000 and dropping. And one time it even had a sell-off that took out some lows, got down to near 1,600. And that was a 20% drop from peak to low, which, think about it. Stock market does that quite often. Why is it the end of the world for gold? Well, anyway, that quickly was erased back to 2000. In March of 2024, when gold was still around the 2000 level, so meaning this resistance level, we said, this time it's for real. You're going up. You're going to accelerate, at least more so than you have been for the prior 3 years. And it did. You went up to like 2,400, and then you pull back, and then you have these monthly stalls where you, for 3 or 4 months, it does nothing. And everybody thinks that's the top. So it's fooled people all the way up. And we argued with this recent break, which was very sharp. In fact, it was like 2 days. If you go back to the drop from 3,500 down to the 32,000s was like mostly in a 48-hour period. And now we're back, pushing the old high closes like 34.25. So we traded up to that level today. Didn't close, not that it matters. But the one we think gold has still got a lot more to go. And that from now on, the type of breaks you're going to get will be more like this one, and probably less so in percent-wise. And this wasn't that big of a percent drop anyway. It was like 9%, I think. And before you knew it, it was over with. A lot of the other corrections over the last year have dropped and then laid there for 3 months and scared people. This time, I think they'll be more rapid, and you'll make a new high. Quick drop, new high. And that's going to shake people out all the way up, unfortunately. The one we still think, and now I love it because Goldman Sachs says I'm wrong, silver. Silver is underperforming gold. It has been, especially since 2023. The spread was at a certain level, and it is staircased down, and it got under 1%, meaning you divide an ounce of silver to gold and drop to 1% and less, where it is right now, of an ounce of gold. If you go back historically, that is dirt cheap. I mean, that's been seen several times, and it's always a buy, by the way. But it's like, what do you think it's going to do? Go to zero? Okay. So, I mean, the relative performance of silver to gold has gotten to an extreme low that has occurred before. And we still think, based on technicals, not the fundamental assessments that Goldman Sachs came out with just the other day, saying that, no, silver's never going to gold's not going to be matched by silver, period. And they cited some fundamentals and so forth, which is fine and dandy. Fundamentals that shift every year type of thing. We're looking at the technicals, and the technicals tell us, no, this pullback has structure above it to break out through, and it won't take a lot to do so. In other words, a very small percent up gain in silver versus gold from where it is now. And if you plot the spread relationship between silver and gold, and especially run momentum of it, you'll see, this is ripe for a breakout. But you've got a structure that would impress you. If you looked at the momentum. If you look at the price of silver also, silver made a high at 30, or about 33 back in May of last year, a full year ago. Where are we trading now? 33.30 today. So we're basically where we were a year ago. After that May high a year ago, it dropped, came up, then made a new high at $35 in October, and again dropped down close to 30. And then in March of this year, got up to 35 again. And again, they sold it at the 2 peaks now at 35. And you dropped down so hard in that panic, and erased it almost immediately, by the way, that you swept some prior obvious price chart lows. The kind of things that a guy with a price chart would say, oh my God, it's all over. Okay, fine, good. Bear trap. Next thing you know, silver's back up to 30, 31, 32, 33. And even, July silver, which is now we call the front month, traded up to 34 a week or two ago. So now, is it the front month so far? The high has been about 33.80, I think. We're trading 33.35, 33.40 today. We think if you ever get back up to 35 again, and I think you will, price chart is then back to what we call a triple top, if you have a point and figure chart. Well, silver doesn't stop at triple tops. It doesn't even stop at double tops. It sets them up. It becomes not a double top, but a launch pad for a new leg. If you return to that launch pad again at $35, it's not breaking out at that point. It's up to the triple top, quote unquote. But quarterly momentum, which we plot in various forms, has a 1 year long gradual downtrend tube that is so perfect that if you looked at that momentum chart, you would say, ooh, this is something you could break out above. You get up to 30, even the high 34s now, I'm going to break out of that channel on momentum that says I'm engaging. And I think at that point, not only will momentum engage, but silver will blast out the 35 level. And this time, I don't think taking out 35 will lead to a $4 advance. I think it's going to lead to something that blows out the $50 very quickly, the old highs of history. So I think silver is sitting on a launch pad or a slingshot situation, and it's going to suddenly do something that would surprise people, and that is catch up and then advance more than gold on a percent basis. So personally, I'm watching gold because it's the mama, but silver looks like the wild dog that's going to vastly outperform gold. That's my bet.
You know, every time I open a chart these days, I feel like I'm watching the same movie play out with slightly different actors. We've been stuck in this range-bound gold saga since the summer of 2020, back when gold first hit that $2,000 mark and everyone was calling for liftoff. And what happened? Just like clockwork, we pulled back. Hit $2,000 again, pull back. We even dropped into the 1600s for a while. And you'd think it was the end of the world based on the media reaction. But that's how it goes with gold. The moment it breathes wrong, half the financial world acts like the sky is falling. But I want to make this clear right from the top. These aren't random jitters. They're the symptoms of a market that's building pressure, and eventually something gives. We're not in some endless loop of 2000 fake-outs. What we're seeing now is different. Let me walk you through the recent action. March 2024 rolls around. Gold's hovering near $2,000 again. But this time it doesn't just flirt with resistance. No, this time it breaks out and pushes up to $2,400. A proper thrust. Everyone cheers. Headlines light up. And right when it seems like the train's leaving the station, what happens? Boom, retrace, fast. Like 2 days of vertical panic selling, dropped almost 9%, erasing all those gains like they never happened. But here's what separates this move from previous ones. That drop didn't stick. We rebounded just as fast. In technical terms, it's a violent shakeout, a classic bull market tactic. You get people to jump in, then scare them out. Wash, rinse, repeat. And if you can't handle that kind of volatility, you're going to miss the main event. Because here's the trick. Gold isn't giving us the lazy corrections it used to. Not anymore. Remember the old corrections that lasted 3 months, where gold just sat there and went sideways? That's not the playbook now. Now we're seeing short, sharp pullbacks followed by immediate rallies. And those types of setups usually mean one thing. We're in the middle of a structural breakout, not a top. Let's put it this way. How many more times are people going to call the top before they stop guessing and start analyzing? Because the charts are screaming momentum breakout. We're not in the accumulation phase anymore. We're in the launch phase. And here's another thing nobody wants to admit. Foreign investors are getting burned badly. Think about it. You're sitting in Europe or Asia, buying into the US stock market or T-bonds, and the dollar drops 5% in a couple of months. So not only do you lose on the asset, you lose on the currency conversion. Double whammy. Just a few months ago, the dollar index was at 110. Then it slipped to 104. Now we're down near 99, even dipping to 98. That's a major structural breakdown in annual momentum going back a decade. We used to say 100 was the support line. Well, that got blown out like a cheap tent in a hurricane. And remember what's in that dollar index? Mostly the euro and the yen, 71% of it, in fact. They were in a stalemate with the dollar for a while, but now they're moving. And that movement isn't helping the dollar. It's undermining it. So if the dollar's going down and you're a foreign holder of US bonds or equities, your wealth is evaporating from both ends. Let me give you the broader takeaway. When the dollar breaks structurally, it doesn't just affect Forex traders. It affects every asset that's priced in dollars, T-bonds, US equities, commodities, and more importantly, it makes gold look a whole lot more attractive. Why would you hold a melting ice cube when there's a finite asset breaking out on long-term charts? Let's talk bonds, because if there's one market that's quietly setting off alarm bells, it's the T-bond market. Back in October 2020, we turned major bearish on 30-year T-bond futures. They were trading at 170 back then, and a year and a half later, they started to break down hard. Not just a little dip. I'm talking about a waterfall collapse that took out every key level going back over a decade. Now, sure, they've been bouncing around in a sideways range since 2022. You might think they're basing. But here's the key. The damage was already done. The long-term downtrend in yields, broken. The bullish structure for bonds, gone. And the market hasn't repaired that damage since. So what does that tell us? That bonds are no longer the safe haven they used to be. The old playbook was simple. Stocks crash, people buy bonds. Worked great in 2000, worked again in 2008. But this time, not so much. Bonds aren't catching a bid like they used to. Because investors can read the writing on the wall, we're not in a deflationary spiral. We're in a stagflationary mess, and rising yields just mean bigger problems. That's why gold is starting to act like the new T-bond. It's the only asset with real stability and no counterparty risk. And people are starting to catch on. But let's shift gears for a second and talk silver. Because while gold has been putting on a solid performance, silver has been, frankly, disappointing, at least to the untrained eye. Since 2023, silver has been underperforming gold steadily. The gold-silver ratio just keeps climbing, and people are starting to wonder if silver will ever catch up. Here's what I think. Silver is lagging for a reason. It's the setup. This is what slingshot patterns look like. You're building pressure, shaking out weak hands, and just when everyone gives up, boom, it explodes. Let me back that up. Silver made a high around $33 back in May of last year. Then again in October, it poked up to $35. March this year, same thing. Another failed breakout around $35. And each time it gets sold down like clockwork. But that's the point. You're forming a perfect triple top on the price chart. And here's the kicker. Silver doesn't respect triple tops. It launches from them. If you're watching price alone, you might not get it. But if you're watching momentum, real momentum, you'd see what's coming. On our momentum charts, silver has been carving out a slow, perfect downtrend tube for a year. And it's right on the verge of breaking out. Just a little push into the high 30s, and that momentum structure detonates. At that point, it's not just about breaking above $35. It's about igniting a structural breakout that blasts through $50 like a cannonball. And once silver clears $50, which, let's remember, has been a hard cap since the Hunt brothers were around, it opens the door to a completely new price discovery phase. That's not hopium, that's structure, that's momentum, and that's what this market is setting up for. So where does that leave us? Gold is still the signal. It's leading, but silver is the lever. And when it plays catch-up, it will move faster and further than most people are prepared for.
Government debt and so forth is off the page. And at some point that derails, or you have to reinvent reality in some way. So it's not something that simply mildly goes away over time. So it could have an event of its own, and it's obviously a huge asset category. But the other factor you mentioned was the dollar. And if you're a foreign buyer of U.S. bonds or a foreign buyer of U.S. stock market, and I understand for people who measure this stuff, that foreign investors in the U.S. stock market over the last couple of years have gone off the page. Never seen so much foreign money invested in the U.S. market. They not only got gut kicked by the stock market drop or the T-bond drop recently, but they got gut kicked by the fact that the dollar, 4 or 5 months ago was 110. It's now trading at 99. And even back in March, it was trading over 104, and now it's 99. So it's even just then a 5% drop. You add that to the negatives of the stock market drop, and you, a foreign investor, getting hurt far worse than an American investor, because he tends to ignore the underlying real value of his money in it. So that's a wave factor, and it hasn't been. The dollar index 2022, 23 and 24 especially was an exceptionally narrow range, 7% range, up, down, going nowhere. And that means the euro and the yen, which constitutes 71% of the dollar index, were effectively doing the same thing, going nowhere really. So they weren't a wave creator. They weren't creating negatives or positives. Now they're creating negatives. So we assess the dollar in the recent drop has blown annual momentum going back well more than a decade. And therefore a major, and even on price, they tried to hold, you don't see it here on the right, but those levels you saw in 23 and 24 were, they traded down to 100. Your closes didn't, but they actually traded there. Yeah. Well, we broke below that decisively, got even down to 98, I think, recently. And then they tried to bounce recently, but even price now, our annual momentum broke up there at 104. You see a little jiggle up there? Yeah, we turned major negative right there. But now it's gone further, and it's, as far as we're concerned, this is the onset of a major bear trend. Well, that's going to have domino effects in other asset categories, as I mentioned. The bond market has fooled us to some extent. In October of 2020, we turned major bearish on T-bond futures at 30-year bonds, long end. They were at 170 at that point. And a year and a half later, they finally really started to come down hard, not just incrementally, but they almost like had a crash type event. They made a low in 2022, meaning a high in yields. And they basically did this 22, 23, 24, went sideways in a range that looked like, oh, they're basing. Okay. Problem was that break, when it occurred in 2022, broke annual momentum of T-bonds, meaning you could go back a decade or so and see on momentum that you just blew a structure from hell. Okay. And the yield guys could see this on long-term yield charts too, where you broke out over a major downtrend line. So you did extreme damage to the prior trend, meaning the trend toward lower rates. And so it's not something you just, dust yourself off and turn around and go up again, meaning drop in yields. There was a technical situation back late last year, early this year, where we thought the T-bonds could do their normal thing, and that is when the stock market starts to look vulnerable to asset managers, as it did.
So where we left off, silver sitting on a slingshot, a triple top on price, yes, but momentum tells a very different story. And as anyone who understands market structure knows, price is the surface. Momentum is the undercurrent, and that undercurrent is shifting fast. If silver breaks above $35, and I mean even just for a few consecutive days, you're likely looking at one of the most significant technical breakouts in the last decade. This isn't going to be some casual grind higher. No, this is the kind of move where we skip the 40S and lurch straight to 50. And once we clear that psychological barrier, what's to stop it from gunning toward 75 or even 100? Now, I know that sounds aggressive, but let's go back and look at how silver behaves when it actually breaks out. It doesn't trickle, it launches. You don't get slow, digestible gains. You get vertical panic buying from institutions who suddenly realize they're on the wrong side of the trade. We're in a period now where the lag in silver isn't a bug, it's the feature. It's doing what markets always do before a breakout, wear everyone down. If you've been watching the gold-silver ratio, it's sitting at absurd levels. Over 85-1 at times. Historically, every time that ratio gets this stretched, silver doesn't just catch up, it rips. And that's the point of structural setups. They go unnoticed until it's too late to react rationally. Let's put it this way. Silver is the compressed spring. Gold has already started its move, and the institutions are already positioning. But when the shift to silver begins, it won't be orderly. It'll be frantic. And don't forget, unlike gold, silver is a smaller market. Less liquidity, thinner float. Which means when serious money starts pouring in, the price action becomes exaggerated. Think of it like trying to park a semi-truck in a garage built for a bicycle. You get distortions, violent ones. Now let's step back and assess where we are in the broader macro environment. I'll say this plainly. We are in the early innings of a seismic asset class rotation. Bonds are broken. Equities are losing trust. The dollar's structure has cracked. And gold is quietly reclaiming its place, not as some fringe store of value, but as a primary reserve asset. What does that mean? It means the psychological tide is turning. And with each passing month, as inflation expectations remain elevated and real yields get increasingly manipulated, the smart money isn't asking whether to own gold. They're asking how much. Here's an interesting observation. For decades, investors treated the bond market as the ultimate signal for safety. But that signal is broken. Back in the 2000s, when equities got shaky, capital rotated into long bonds. 2008, same playbook, but now, not happening. When yields broke out of their long-term downtrend and T-bond prices collapsed, it wasn't just a technical failure. It was a signal that the era of bonds as safe havens is over, that damage hasn't been repaired. And let me say this clearly, the bond market is not going back to where it was, not structurally, not fundamentally, and certainly not psychologically. You can't unwind $34 trillion in US debt with 5% yields and think everything's going to be fine. Eventually, you hit the wall, either through higher interest expense breaking the treasury or through central bank interventions that destroy credibility. And that's why gold is thriving. But here's what I find even more compelling. Gold miners haven't even started their revaluation. You'd think with gold at $2,300, these mining equities would be exploding, but they're still trading at levels that make no sense. That disconnect is an opportunity. You're talking about companies with price-to-cash flow ratios at multi-year lows, even while their underlying product is at all-time highs. Why? Because the market doesn't believe gold's price will hold. It thinks this is temporary. But when gold starts to base around $2,500 or $2,700, and that becomes the new normal, institutional money will reprice these miners almost overnight. The same goes for silver miners. And here's the thing, because silver has been lagging, the miners tied to silver production have lagged even more. It's leverage on leverage, which sounds risky, but if the macro trend is your friend, it's how you turn moderate breakouts into explosive gains. Let's look at sentiment. Retail is still largely out of this market. You don't see headlines on CNBC about gold miners. Twitter isn't filled with number-sign silver stacker threads the way it was in 2020. That's a gift. The crowd isn't here yet, which means positioning now before the floodgates open is how you get paid. And let me tell you something. When physical demand sets the price, it won't be 2,400 gold and 34 silver. That's a paper illusion. The real price is what someone will pay to take physical delivery, when there's 120 contracts per real bar on COMEX. So when silver breaks $35, and I believe that day's not far, you will not see a $38 pullback. You'll see 42, 46, maybe a wick to 50, and it won't be news-driven, it will be technically driven. Then people will start searching for a narrative. Oh, it's solar, it's a supply shortfall. Nonsense. It's momentum that drives price first. Fundamentals show up after the move to validate it. That's how markets actually work. Now let me talk about volatility. This isn't going to be a smooth ride. Breakouts like these are violent. They trap bears, they confuse bulls, and most of all, they exhaust traders. That's what a bull market does. It climbs a wall of worry and throws people off every 10% up move. You've got to anchor to momentum. If price pulls back but momentum stays above key thresholds, that's a buy. If price rips but momentum diverges, that's your exit. Not CNBC, not Twitter, not your neighbor who just discovered SLV. Momentum is the truth serum of the market. And speaking of Twitter, have you noticed how quiet the gold is dead crowd has gone? Back when gold was stuck under $2,000 for years, they were loud. Now that we've broken out, they're nowhere. But when silver starts its run, expect the noise again. You'll see influencers pumping junior miners, ETFs, some maybe even crypto silver hybrids. That's the mania phase. That's when silver leaves $50 in the dust and heads toward triple digits. I'm not predicting $100 silver tomorrow, but I am telling you that the path is visible. The momentum groundwork is there. All it takes is one event. Could be geopolitical, could be another bond market panic, could be a central bank surprise, and boom, the slingshot snaps. And here's a little humor to wrap this up. You ever seen that meme of the two buttons? One says, believe the Fed, and the other says, believe gold. The guy's sweating, hand trembling, can't pick. Well, if you've been in this game long enough, you already know which button to press. So here's your roadmap. Watch momentum. Watch silver's $35 level. Watch the dollar index's next failure to bounce. And watch the bond market lose its last friends. This cocktail is brewing. And when it's ready, silver won't ask for permission. It'll explode. Hold on to your convictions. Because this isn't just a trade, it's a shift. The old monetary order is cracking. Gold is rising in prominence again. But silver? Silver is the surprise, the sleeper, the wild card that could outperform everything in the years ahead. We'll be back with more analysis as this unfolds. But for now, stay vigilant, stay informed, and stay positioned. The charts are speaking, and if you listen closely enough, you'll hear the sound of history repeating itself.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.